buy land. They're not making any more of it. Well, you know what they are making a lot more of? Fiat currency. A growing number of analysts see the central banks as stuck in a trap of their own making. Better get busy inflating or get busy defaulting. Now, understanding that there may be surprising twists and turns along the way, panelists, I'm curious if you agree that inflation is the predictable ultimate endgame here for the world's major fiat currencies. Why don't we start with you, Jim?
No, I don't agree. It's not predictable, and the reason is money supply is irrelevant to inflation. It's not the determining factor. The determining factor relating money supply to inflation is velocity, which is the turnover of money. That's a psychological phenomenon, behavioral phenomenon, which the Fed cannot control. The Fed can control M0. They can stick the landing. They can make that number whatever they want, and they have. But velocity, just to give a simple example, if I'm feeling good, if I'm feeling prosperous, if prospects are good, and I want to go out to dinner and take my friends and drinks on me, that's one state of the world. And I tip the waiter, and the waiter goes home and takes an Uber and tips the Uber driver, and the Uber driver puts gas in his car. Well, in that example, my money has velocity of 3. $1 I start with produces $3 of goods and services. But if I'm depressed or worried or more into precautionary savings and I stay home and watch TV, my money has velocity of 0. And I remind people that $7 trillion times 0 is 0, at least where I went to school. So the point is, velocity is the driver. It's psychological. The Fed can't control it. I always say it's a sad day when a central bank wants inflation and can't get it, but they can't get it. They've forgotten how. I could remind them, but they don't know how themselves.
Velocity is the only essential element. And actually, if you look at money supply growth, but if you look at the delta of money supply itself, we're on the cusp of it turning negative, in addition to money velocity, as Jim says, being as low as it is. So they really don't have a choice right now because of the inflation that 43.2% of US GDP being injected directly into the veins of US households' checking accounts has caused. Now, I've just come back from 2 weeks in Europe, my first time abroad in 5 years. And I can tell you that the rest of the world right now is extraordinarily resentful of the level of fiscal stimulus that was pumped into the world economy, because it's caused inflation not just here in the United States, which will be transitory in the end, and we're also all dead in the end. But demand is slowing appreciably right now, and people are not seeing it because there's still so much flushness out there. But I can tell you that inflation has become very problematic in the medium term, and it is something that has emanated from U.S. fiscal policy double barreling with monetary policy.
Right.
Right now, I agree with Danielle that inflation, as we see it, there are base effects, there are supply chain effects. It's transitory. We're going to tip fairly quickly into disinflation and deflation. However, if you go out 2 years, we're absolutely going to have inflation. So it's difficult. People say, oh, make a remind. No, it's just we're going to have disinflation for now, maybe borderline deflation. We're going to have to be really careful about that. We might have a global recession in 2022. And the rest of the world's not far behind. Japan's there, Europe is close. China, they lie about their numbers, but they're probably, they've produced the worst growth since 2008. But that said, when you get into 2023, beyond that, I would expect an inflationary world for reasons that have nothing to do with what we're talking about, but more demographically driven.
On a long enough timeline, everything is transitory. But I think we're going to see, just as Jim and Danielle have said, some pretty interesting inflation going forward. We're already seeing it right now in energy like crazy. Coal is up 300%, the price of coal. U.S. production of coal is up 22 to 25%. And why is that? Because you can't just pull on one lever as far as energy without all of them running along with it. People are going to try to buy anything they can to supply the energy that they need. Natural gas in Europe is 3 or 4 times what it is here.
Today we have markets at all-time record highs. Now we're looking at 2022. The Fed is talking a big game about tapering. So the monetary side looks like that barrel is going to be emptying. And Congress is having much, much harder time passing the fiscal stimulus side of things.
That's
and I've heard
lynchpin.
many analysts say that we are staring at the largest monetary and fiscal cliff at the same time in history. I guess just a quick poll of the panel here. What's the probability of this resulting in a material correction in the markets? And by material, I mean a 20+% correction in asset prices because of this turning off of liquidity spigots to miss.
No, I mean, I think right now, if you look at the 10s 30s spread, that's been compressing pretty quickly. That tells you that there's going to be pressure on the 10-year nominally. And we're seeing the flow through for the first time in this last CPI print. We saw 0.5% print on rental inflation. That's sticky. It's persistent. It's not transitory. It's not a supply chain issue. It's not Chinese. It's not energy. It's sticky. And it's 43% of the CPI, and leases are 12 or 18 months long. So the Fed has a real problem on its hand, and that's not going to work for very long. And that's why you're seeing, I mean, if there's anything that I'm following right now, it is how quickly the 5s 30 on the yield curve is compressing. Just put it on your radar, make a note, watch the 5-year, 30-year spread. The Fed won't have anything, they won't have tools in their toolbox to address an inverting yield curve if they also need to be tightening. So this is a real cluster mess. I want to add something though here, because it is somewhat anomalous when you talk about car sales being down for 6 months in a row. That's what Cox Automotive is suggesting for the month of October. So 6 consecutive months of falling car sales in US history is a 99.4 percentile occurrence event. We saw it in February and in March and April of 2008 and in February of 2009. Those are the only 3 months in US history during the great financial crisis that we saw 6 back-to-back months. So why the hell is the stock market so high? One thing that we have to bear in mind right now is that on February 19th, 2020, the US corporate bond market passed $10 trillion as a milestone. Now we're at about 11.5 trillion. So you can't count out the power of all forms of liquidity, especially share buybacks that are being financed by debt. And that's right now one of the reasons that a lot of people, I think, are scratching their heads and saying, what's going on here? You've got the Fed and corporate America really pumping liquidity into the stock market. And that's one of the reasons that the bond market and the stock market are in such disagreement right now.
We're watching a movie we've seen before. So here's what's going to happen, because here's what did happen. In May 2013, Bernanke announces the taper. He didn't use the word, but he implied that. November 2013, they start the taper. November 2014, they finish the taper. No more net purchases. And then we get ready for the liftoff. March 2015, Yellen removes the word patient from the statement. That's your clue. That's your magic word. You know, they're going to raise rates. But they didn't raise rates until December 2015. It took that long to raise rates, but they did. And the next 25 basis point increase was December 2016. At that point, they got a little mojo, and then they kept raising rates. But what happens next? From October 1st to December 24th, 2018, the stock market fell 20%. In other words, the Fed proved that they cannot normalize. They proved that they cannot raise rates, they cannot reduce the balance sheet, they cannot do what they want to do, and nor can they get inflation, because they never did. So we saw that whole movie. Now, what are they doing now? So then they do it in reverse. You had the Christmas Eve massacre, 2018. Then the week between Christmas and New Year's, Powell gives some kind of speech, says, I guess we better stop raising rates, you know, that signaled that. So then 2019 comes along, and Powell progressively lowers rates. You know, and then the pandemic, he gets back down to zero. Okay, so then a year goes by. What are they going to do? We're going to taper. And they are. In November, they'll start the taper. They'll finish it by June of 2022. And then we'll get ready for the second liftoff. They're doing the same thing over again. And they already proved they can't do it. So as they proceed to do it, except one difference, the market saw what happened between 2013 and 2018. They watched the same movie the rest of us did.
Yeah.
So pardon me, they're anticipating the ending. They know how this ends. So the correction will start soon. Now, just to be clear, the S&P is in a huge bubble, an historic bubble. People say they can't see bubbles. Bubbles are easy to see. What's hard is knowing where they end, knowing how long they go on. So I don't want to, it is a bubble. I feel confident about saying that. I don't want to say it's going to pop soon. So I always say, if the perception is here, you know, the stock market is running on a narrative. If the perception is here and the reality is here, reality always wins, but it can take time. So yeah, I would expect to have some dry powder. If you have cash and things fall apart, you can pivot. If you're in private equity, for example, good luck getting your money back from Henry Kravis.
Right.
Great firm, but they're not going to give you your money back. So people, they don't sell what they want, they sell what they can. But if you have cash, you're the person who can look around, you can pivot quickly, you can go shopping in the wreckage. So that basically it's not the money call on every asset class in the world. That's valuable, and people underestimate the value of the optionality, number one. Number two, it reduces the volatility of the rest of your portfolio. So if you have stock, gold, real estate, and so forth, you can sleep a little better at night. It's the opposite of leverage, in other words. So yeah, I recommend some cash, maybe a big slug, maybe 30%.